So after the S&P opened up about 3.5%, we wound up closing down, sitting right on our 200-day moving average. Now, this is not the worst space in the world for us to settle in going into the FOMC meeting. As always, subscribe to the channel, click all notifications, especially if you want updates and you want to know what's going on with the economic data. Tomorrow, we're going to be live for the Fed meeting starting at 2 p.m. So make sure you are subscribed so that the notification goes out. Click all notifications. We have a clearly defined level sitting up here. And I know a lot of people today are disappointed by today's action. Quite frankly, I think it's great. I would rather fill the gap now than fill it 11 days from now. And gaps get filled. Not all the time, of course. You have a gap down here that's been completely ignored. What have we done a really good job of over time? Filling gaps over and over again, right? So when we're filling these gaps in, why wait? Just get it done. Rip off the Band-Aid. And that's exactly what we did today. So I don't have a problem with today's action. I think it is somewhat naive to think that we were going to go up 1.5% on quote leaked information. And then we were going to just go up another 3 or 4% today. Everything was going to be rosy and people were going to hold into the Fed meeting, which is tomorrow. You have to put all the pieces together, right? So we have this trend line up here and we can see that pretty clearly. But this is pretty textbook stuff. News hits, news is good. Trade up, you have that complete, utter blow off move, right? And you can see that really clearly right here. Just absolute blow off. Everybody's got to get in. I'm going to miss it. And then what happens? Boom. And then it just starts. And these are pretty simple patterns. 1, 2, right? 1, 2. So, and then they just start breaking. And then, the pain just starts during the day. Now, there were some great trades to be had today. And there's some stocks that look really good. And we're going to go over those. So make sure you stay to the end. If you look during the trading day, you could see how VWAP, once VWAP broke, that was it. If you're not utilizing VWAP right now, you're just behind the game. You need to really have this in your charting system if you're intraday trading. You're just at such a disadvantage because it's just been controlling the moves of the market. I'm going to show you a couple stocks in a moment here, but you can just see the break right here and you can see what happened. And then it was just down. These are second standard deviation moves that I put on VWAP. And I do it just to give me a range because it lets me know sometimes like, hey, maybe if I reverse here, I might regress back to VWAP. It just gives me an understanding of where we are at. I don't really view this as that bad of a day. I mean, I guess people keep thinking that they're going to get 2020. You're going to get 2020 again when the Fed injects $1.7 trillion into the market. Until then, stop thinking of trading like that because it's never going to happen again. I'll just save you a lot of time and heartache. So you gap filled down here, form a bullish harami right there. I'll link that candlestick video at the end of this so you can learn what they are if you're not aware. And then you can just see how we start trading up into the close. Got back to VWAP. Not the worst close in the world. The numbers were solid. Core CPI, 6% versus 6.1. Previous was 6.3%. Month over month, 0.2. We were looking for 0.3. CPI month over month, 0.1 versus 0.3. Coming off of 0.4. This is huge. And let me just put this in perspective. If you were to annualize this, right? Just think about that for a second. If you just simply annualize this, where does it put you? So that's definitely something that you should be thinking about. Now, year over year, 7.1 versus 7.3. That's right where JP Morgan and Goldman were saying, if we see a number like this, we could be up 5 or 6% today. Now, today you learned a lesson. They are not your friend. So essentially what they did a great job of was creating an absolute fury into the market. And then the institutions just sold and took profits all day long. Okay. So just keep that in mind when you start reading this kind of institutional content. Understand that they're just not giving out free advice just for the heck of it. They have a motivation. This was really clear what their motivation was, and they executed it perfectly. Now, tomorrow we are looking for a statement, and we're going to see what he says. Now, everybody is focused and has their opinion. What I always find fascinating is when we see these comments come out of investment banks. So this explains what JP Morgan is looking for. They're expecting it to be just like the Brookings event. That was very positive for the market, okay? But I think that when you start seeing this kind of language, restoring price stability, that the committee continues to anticipate that ongoing increases in the target range will be appropriate, right? So it's kind of interesting to me that they know the exact statement that he may or may not say. Given the persistent strength of the labor market, He will make the case to get their terminal levels. He'll need to stay there for a long period of time. This is what you need to watch tomorrow, what he says about the terminal rate. And you need to really pay attention. Does he increase the terminal rate from where it currently was? Because if he does, that means that we could be looking at another 50 basis point rate hike. We're not expecting that in February. We're expecting 25 basis points right now. So that would be negative for the market. And we're going to have to listen to that language. But we don't want this door left open for 50 basis points in February. We want the door closed, or we want some semblance of that. So there, another statement is that they expect monetary policy affects the economy and inflation with certain lags, and the full effects of our rapid tightening so far is yet to be felt. Now, what he's basically saying here is the fact that we tightened so fast, we don't even know what we've done. That's essentially what they're saying here. And I agree with that. I think the bond market's responding to that very favorably. This is the 20-year Treasury. Now, this was the CPI moves, and you can just see exactly how we're acting on them, right? So we're doing fairly well off of those kinds of moves, and we're seeing buying in the bond market. The 10-year Treasury sitting right at 3.5%. We are watching the 55-day moving average start to curl down. This doesn't get any clearer that you have an island here and that you're probably heading back down to this 3.25 range. That's not the sign of a market that's telling you that we're going to see infinite rate hikes. The dollar continues to implode, and I think there's a lot of pertinent information on this chart. Technically, these are the Fibonacci or Fib levels based upon the low of the year and the high of the year. Now, I put the 50 line in as a demarcation line. That's not really a Fib level. But you can see how we responded to these Fib levels in this area. So it's very possible that we're heading to this one, which puts us at about 102. You can see the rolling of the 55. You can see how we broke the 200. And if we just stayed here, we're actually going to form a death cross on the dollar, which is actually good for bonds and good for equities. There were some great trades out there today. Now, in the trading community, one that we did was this Moderna. Obviously, there was news today, but it was a perfect, absolutely perfect trade. So when you see what happened during the day and you see that reversal, they had everybody trapped. Now, this was really simple. All you're looking for is for this to flip, the opening and then this little wick right there. And then once it does that, we already have confirmation that we're respecting the VWAP, which is the blue line. And this became a very simple trade once we entered. Once we entered and scaled out of the trade, once we were up in the trade, we scaled out of a little bit. And then from there, we had the ability to just very simply lock in our profit and then just move the stop up, right? And then we just move the stop up to break even. But I just want to point something out. And I think this is a really important point that I want to make to people. I have no idea where this is going today. No one has any idea really where anything is going. All we can do is put money management principles around what we're doing. And I'm doing this and explaining this because of the comments that I get. I get a lot of comments saying, can you show more live trades? And I'm working on a system that I should be able to do that shortly. But please, your comments, I do read them. So once you flip this level and you push and you take a little bit of profit out, and this is VWAP, and these are the second standard deviations of VWAP, all we started doing was a very simple backstop on a 5-minute chart. That's all we did. We just kept moving the stop up over and over again until it finally stopped us out. That's what we did today with this. And it worked perfectly because it got us to the point where even here, where you're thinking it's going to happen and it doesn't, you just wait for it to actually trigger. And then when it triggers, that's enough and you're out. Now, mind you, we scaled out twice. So just in case we came down, but you want to scale out of these. But then the moment that it finally breaks, that's it. You are out. And what usually tends to happen with these kinds of moves is that where you finally had support, it starts to become resistance. And that's exactly what happened today. But this little simple move when we got in this actually led to a huge victory. We made 13 points on this little move by nothing more, nothing crazy, nothing new that you have to learn, except keep moving your stop up to the low of every 5-minute bar. That's it. That's simple. You could have played the VWAP bounces. You can see those pretty clearly. We did not do that. Now, the one thing I want to hammer home, we did not chase off the open. What we did was we just watched and we just waited and we just let them set up. We let them set up. We watched everybody else get giddy. And then we just simply waited to flip a certain level. And then we just got in, and then as it moved up, we just started scaling out of some, and eventually we got stopped out of the rest. Now, I'm not sure if NVIDIA's over. I think it's great that we broke the 200 here, and this is the first close above the 200 since April. I don't know if this move is over or we're going to rest and build. My hope would be that we build here and that we start seeing the 55 come in right behind it and start turning upwards, which it's doing here at a trajectory we have not seen all year. So I do like the action here, but you need to be cognizant of what stocks had momentum today, because when you go into the Fed tomorrow, winners win, losers lose. So whatever was weak today, you can expect to be weak tomorrow on macro news. Same thing as what was strong today. Something like Microsoft, right to the 200, bounces off, but you're still above this key level. If you drill into this, you can see pretty clean. We didn't even gap. And I would tell you to consider to keep looking at some of the larger cap names so you have liquidity for your moves. But you see how you started to trade back up during the day? So your low was the middle of the day, and then you just had buying. It's not like the buying went away. You just didn't have retail propping you up, right? So probably, if you think about it, institution sold to retail, retail gets hammered, institution picks up the pieces later and starts getting long into the Fed. That is one scenario that we might want to consider might have happened today. Now, the exact opposite story was Tesla. How is this the exact opposite? We gapped up and we just never looked back and sold down all day long. Now, this was something that I was interested in shorting. It was actually in our newsletter for the trading room this morning. I didn't really get too heavily involved on anything more than scalp trades in this, quite frankly, because I was more interested in trades on the long side at the time. But when this broke these levels, we did have people that decided to put the trade on, and they did fairly well with the trade during the day. Now, why this name? On the daily, we did not gap up. Everything else gapped up today. This bar stayed right in the middle and continued to see pain and actually took out that low. And once you took out that low, 167, that was it. And you just saw more pain. So if we gap again tomorrow, I would imagine that you start seeing the same exact thing happen. Now, if you have any questions, please reach out. As always, if you are interested in joining the trading community, there is a link up here in the top right. Don't forget tomorrow that we will be live at 2 o'clock for the Fed, and we will stay live. Jerome speaks at 2:30. Sometimes he speaks a little earlier, and then we'll stay there for that period of time. Everybody have a great evening. Trade safe.